What's your take on this weekend's developments, particularly from the Treasury Secretary?
Well, first of all, Merry Christmas to both of you. You're not going to get a better rundown of the backdrop here than Steve Leisman just gave you. It's commonplace and appropriate for the Treasury Secretary to speak regularly to the heads of the largest banking and securities firms. What's unusual here and what was a mistake was issuing a statement concerning liquidity when no one is concerned about liquidity, and it implies either that the administration itself is concerned about liquidity and wrongly so, or that the Treasury Secretary is out of touch with real business, credit market, and financial conditions. But however you slice it, it was a mistake. All you do by issuing a statement about liquidity when no one's concerned about it is to cause people to wonder whether there actually is a problem when indeed there isn't.
So I can tell you definitively, Roger, just to clear something up here. I mean, according to a senior Treasury official, they were not worried about liquidity going into this call. And the message they got from the CEOs was that everything's fine. And that's exactly what they expected to hear on this call. They just put it out to the public as they were trying to, people ask about liquidity when you get big market meltdowns. And they were actually really talking about the economy and some of the other concerns out there. And the mistake, I think, according to Treasury, might have been whether to lead with that liquidity point, because that wasn't the point, that they were worried about it.
Well, Sarah, as Steve said, and I'm echoing, putting out a statement essentially saying that liquidity is ample when that type of is only made typically during credit crises or other emergencies is just not a wise thing to do. Look, it'll pass, but it's unfortunate that the Washington overlay as a whole, blasting the Fed, raising issues about whether you can fire the chairman when you can't, the shutdown, the trade war, and so forth, that is obviously putting downward pressure on valuations and the market. And almost all of that is needless.
Roger, when you step back and you see this type of action, what does it make you think about the quality of leadership of individuals at the Treasury and in the White House more broadly?
Well, I'm actually grateful for Mr. Mnuchin because by most accounts, he was the one who persuaded the president to appoint Mr. Powell in the first instance. And when you look at the remarkable dismissals, vacancies, and general chaos in terms of the senior ranks of the government, you say to yourself that we're fortunate that someone who is calm and steadfast and knowledgeable, like Jay Powell, managed to get appointed. Almost seems like a stroke of luck in retrospect, but Mnuchin, I believe, is responsible for that, and that was a pretty important thing. I think if the Treasury, if that position was vacant today, God only knows what Mr. Trump would do. I mean, this is just a low point from the point of view of the relationship between Washington and financial markets, or the impact of Washington on it. We've had other low points. It's not the worst in history or anything remotely like it. These things happen, but it's as I say, it's needless.
So is what you're saying, Roger, is how you interpret the now 20% slide in the S&P 500 off the highs? You think it's policy mistakes and errors like this, or is it some real signs of slowdown in the U.S. economy, or the market signaling something that the economists are not forecasting about next year?
Well, yes, I think it is a measure of the second factor, Sarah, and I respectfully disagree with some of the comments that your guests made a few minutes ago. I think the outlook for 2019 is weakening. And if you look at a whole series of factors like bond spreads, like the trends right now in consumer net worth, like the index of leading indicators, you see incipient weakness. And I think we're going to see that 2019 GDP forecast, which we're running broadly in the very high twos, like 2.9%, are going to be marked down quite a bit, maybe by a full percentage point. So actually, I think the market is reflecting an anticipated slowing, not a recession, but a slowing to a greater degree than we would have anticipated 2 months ago.
Are you seeing that in deal activity, Roger? What does it look like? Is it going to slow down heavily?
No, I'm not seeing that now. But these broader indices that I just ticked off, and you could add a whole bunch of others to that list, commodity prices and a series of others, are tilting in the wrong direction as far as growth is concerned. And we all know that the rest of the world outside the United States is discernibly slowing. So the narrative of synchronized global growth, which we were all discussing a lot 6 months ago, I think has removed itself. We don't have that now, and that was driving markets upward and should have been. And now the outlook has changed. So I don't think it's all about Washington at all. Yes, there's an element of that, of course, a big one, but it's also about the actual growth outlook in the United States, which has been the one engine for the world, and I think that growth outlook is slowing or is changing.